Welcome to U.S. Tax Classroom. Previously, we tackled the first three heavy hitters of Schedule A: medical expenses, state and local taxes, and mortgage interest. Today, we are putting the final pieces of this giant puzzle together. This explainer covers the last three categories you need to know about: gifts to charity, casualty and theft losses, and other itemized deductions. By the end of this session, we will have completely filled in the full Schedule A picture. Here is our roadmap for today's explainer. We're going to start off with gifts to charity, then we'll move into casualty and theft losses, dive into other itemized deductions, and finally wrap it all up by looking at the full Schedule A picture. Let's get right into it. We are kicking things off today with Category 4 on Schedule A, which is gifts to charity. Before we even look at the math, you absolutely must know that to consider claiming this deduction, your contribution has to go to a qualifying organization. What does that mean? It means registered 501c3 nonprofits, religious organizations, educational institutions, or government entities. If you hand cash directly to an individual in need, or to a political campaign or a foreign organization, it simply does not qualify for this deduction. Now, I have a very urgent timing update for you regarding cash contributions. For 2025, your cash contributions to public charities are deductible up to 60% of your adjusted gross income, or AGI. And here's the really important part to understand. 2025 is a clean year. Every dollar of qualifying cash contribution counts. That changes in 2026. Starting in 2026, those contributions are only going to be deductible to the extent they exceed a 0.5% AGI floor. That means that the very first portion of your giving will produce absolutely no tax deduction. The timing of exactly when you make your donations matters tremendously. Let's step through exactly how this looks with a real calculation. Meet Emma. She's single, and her adjusted gross income for the year is $80,000. During 2025, she decides to be very generous and donates $10,000 in cash to her local food bank. First, we need to calculate her specific AGI limit. We take her $80,000 AGI and we multiply it by that 60% limit. That equals $48,000. So $48,000 is Emma's absolute maximum allowed deduction for cash contributions. Next, we look at her actual donation, which is $10,000. Because that $10,000 sits well below her $48,000 ceiling, what is Emma's final deductible amount? The full $10,000 is deductible. Every single dollar goes to work for her tax return in 2025. For anyone planning substantial charitable giving, Emma's situation proves exactly why 2025 is your golden window. Now let's shift gears from cash to non-cash contributions. If you donate appreciated non-cash assets, think things like stocks, real estate, or valuable artwork, and you've held them for more than 1 year, you are playing by a different set of rules. These donations are deductible up to 30% of your AGI, which is half of the 60% limit we just saw for cash. Let's build a real calculation for this specific rule to see how it plays out. Meet George. George has an AGI of $100,000. He wants to donate some shares of stock directly to a charity. The stock is currently worth $40,000 and he has held these shares for 3 years. His original purchase price for that stock was just $15,000. First things first, we must calculate his AGI limit for non-cash assets. We take his $100,000 AGI and we multiply it by that 30% limit. That gives us $30,000. So $30,000 is his ceiling. But remember, his actual donation is worth $40,000. That clearly exceeds his limit. So what is George's deductible amount for this current tax year? His deduction is capped exactly at $30,000. However, that leftover $10,000 is not just lost to the wind. It simply carries forward to the next year, and he can actually carry it forward for up to 5 years. And right here, this brilliantly illustrates one of the absolute best tax strategies you can possibly use. Take a look at this number, $25,000. Where does that come from? It's the difference between George's original $15,000 purchase price and the $40,000 current value of his stock. That is his untaxed growth. By donating the stock directly to the charity, George completely avoids paying capital gains tax on that entire $25,000 of growth. Think about that. If he had sold the stock first, just to get the cash to donate, he would have triggered a nasty taxable capital gains event. Donating the stock directly bypasses that entirely. It is a massive advantage. If you hold highly appreciated assets, you need to talk to your financial planner about this strategy right away. Of course, if you want to claim any of these deductions, having the right paperwork is non-negotiable. The IRS has very strict, tiered documentation requirements based entirely on the size of your gift. Any single cash contribution of $250 or more requires a written acknowledgement from the charity. If you make non-cash gifts totaling over $500, you are legally required to fill out and attach Form 8283.
And if those non-cash gifts exceed $5,000 in total value, you have to get a formal qualified appraisal. Make sure you memorize these thresholds.
Let's look at one more highly effective strategy specifically designed for seniors. It's called the Qualified Charitable Distribution, or QCD. Individuals aged 70 and a half and older can transfer up to $108,000 annually directly from their IRA straight to a qualifying charity. Why is this so powerful? Because QCDs are completely excluded from your taxable income, and they can even count towards satisfying your required minimum distribution. This is a game changer because the standard deduction is so high for seniors that most of them simply don't have enough expenses to itemize anymore. The QCD acts as the ultimate workaround, letting seniors get a massive tax benefit from their giving, even if they just take the standard deduction.
Before we close the book on charity, I want to flag another major upcoming change for 2026. Beginning in 2026, donors who do not itemize their taxes will actually be eligible for a new $1,000 charitable deduction, or $2,000 if you're married filing jointly. This goes right on top of their standard deduction for cash gifts to qualifying charities. But please don't get ahead of yourself. For 2025, itemizing on Schedule A is absolutely required if you want to get any tax benefit at all for your standard charitable contributions.
All right, let's transition over to our next section on Schedule A. This is Category 5, Casualty and Theft Losses. I need to be completely upfront with you here because this is a genuine heads up. Personal theft and most home damage is no longer deductible. Only federally declared disasters qualify. So many people don't realize this rule changed drastically back in 2018. Standard fires in a home that isn't in a disaster area doesn't count. Everyday car accidents, no. Someone breaks into your house and steals your laptop, not deductible anymore. The IRS will only let you claim this if your loss is tied directly to a federally declared disaster zone. Let's walk through exactly how the math works when you actually do meet that strict criteria. Meet Tyler. Tyler lives in a federally declared disaster area, and unfortunately, a recent hurricane just caused $30,000 in completely uninsured damage to his home. Now, Tyler's adjusted gross income is $70,000. When calculating his deduction, the IRS forces you to apply two specific reductions. First, we must reduce the total damage amount by $100. So we take his $30,000 in damage, subtract $100, which leaves us with $29,900. Next, we have to calculate the 10% AGI floor. We take his $70,000 AGI, multiply it by 10%, which gives us $7,000. So after all that, how much of Tyler's tragic loss is actually deductible? We take the $29,900, subtract that $7,000 floor we just found, and we arrive at a final deductible amount of $22,900. Tyler will claim this by completing Form 4684. The big takeaway for you? Having comprehensive homeowners insurance is literally more critical than ever because the tax code will not bail you out for everyday disasters. Moving right along to the final category on Schedule A. This is Category 6, Other Itemized Deductions. This category lives down on line 16 of the form. You can really just think of line 16 as a catch-all category for very specific, uncommon deductions that simply don't fit anywhere else. Things like federal estate tax on income in respect of a decedent. For the vast majority of taxpayers, line 16 will remain totally blank. However, if you do use line 16, gambling losses are far and away the most commonly entered item. But you have to pay close attention to this incredibly strict rule. Gambling losses are deductible only up to the amount of your reported gambling winnings. Your losses can never exceed your winnings. You can't use a bad night at the casino to offset your regular W-2 day job income. Let's slowly build out an example to see exactly how strict this rule really is. Meet James. During 2025, James had a nice streak and won $5,000 gambling. But later in the year, his luck turned, and he ended up with $8,000 in gambling losses. First, James absolutely must report his $5,000 in winnings as income. Next, we look at his $8,000 in losses to see what he's allowed to deduct. Because of the rule we just learned, his deductible losses are capped firmly at the amount of his winnings. So, what is James's final deductible gambling loss? It is capped right at $5,000. That extra $3,000 in excess losses produces absolutely no deduction for him. And unlike the charitable contributions we talked about earlier, he cannot carry that excess loss forward to next year. It's just gone. The takeaway? Keep meticulous records of every win and every loss, because the IRS scrutinizes this section heavily. Okay, we have successfully made it through all 6 categories across our previous explainer and this one. Now, let's step back, bring it all together, and look at the full Schedule A picture. Here is the complete breakdown of Schedule A for 2025. Lines 1 through 4 handle your medical and dental expenses, specifically the amount that exceeds 7.5% of your AGI.
Lines 5 through 7 are your state and local taxes, also known as the SALT deduction, which is currently capped at $40,000. Lines 8 and 9 cover mortgage and investment interest, subject to that strict $750,000 loan cap. Down on lines 11 through 13, you have your gifts to charity, where we just covered the 60% cash limit and the 30% non-cash limit. Line 15 captures casualty and theft losses, which again is strictly limited to federally declared disasters. And finally, line 16 catches those other itemized deductions, like your gambling losses, capped at your winnings.
When you compile all the math from those categories, you finally arrive at line 17, which is your total itemized deductions. This grand total is the critical number you have been working so hard to find. You take that final number from line 17 and you compare it directly against the standard deduction for your specific filing status. That comparison is the whole point of this exercise. If your line 17 total is higher, you itemize. If the standard deduction is higher, you forget Schedule A and just take the standard deduction. It really is that simple.
So, after everything we've uncovered today, you have to ask yourself, are you leaving money on the table by just taking the standard deduction out of habit? We'll find out in our next explainer, where we are going to dive deep and make that exact itemized versus standard deduction decision using real, comprehensive case studies. After working your way through this series, that final decision is going to make complete sense to you. Make sure to subscribe to US Tax Classroom so you don't miss it, and please remember to check the community post section on our channel for regular quiz questions to keep your tax knowledge sharp. See you in the next one.